Hey peeps, 11:37 in the morning on Tuesday. Made two trades this morning. One got stopped out and the other was pretty decent for a profit. I just wanted to show you real quick. We got Sara StratSniper. She's the one that I use the STRAT combo sheet from. There's plenty of combo sheets out there. You can just Google it online and pick whichever one you want. But this is the one that I use. She also has a nice YouTube channel with a lot of easy to follow stuff that you can check out. Just copy it, print it out, and boom, there you go. We had open here at 9:30. A little bit of a run up. We were coming down. I thought we were going to continue and get this move right here. Right off the bat, but of course sometimes you make the right trade but you do it too early or too late. This one was too early. I had an entry right here on a SPY call, a 401 put, and we were at like 403 at the time. I got my entry, put my stop up here, we came down and came right back up and wicked right into it. But it was two contracts. I lost $13 a piece, so I lost 26 bucks. Like those are losses that you can absorb, and you know. So was it going to run up forever? Who knows? But you have your stop there for a reason. It's to prevent you from taking a catastrophic loss. You can absorb 5 to 6 stops for every one winning trade, and just as I'll show you next. So this was my first trade of the day. Let's just erase this stuff so it's not confusing. My second one of the day went much better. We got in on this ride right here. Yellow as my entry. I took my sell from up here at the top of these wicks to SPX 4065 calls. We got in them at 40.24 and we sold at 40.37. And when you look at the chart, you're like, wow, the strat is amazing. It gives you clearly defined sell points, and if you stick to the system and you're disciplined, then you will win. And if you don't, then it'll turn and kick you in the junk. You know, now granted, you know, it came back up to a reasonable level, but the farther you push into the day, the less you're going to see the same price move, get the same profit or loss results. So that's great in the terms of losses, but not in the terms of profits. This move at the beginning of the day got me $150 on the SPX minus the 26 from the stop out. So we're up 124 on the day. It was a nice little trade. Big confirmation candle, flip of the BT cloud, both the 9 EMA crossing the 14. We back tested here. We waited for, I wasn't so patient over here, waiting for the second back test. But a lot of times you're rewarded if you wait for the second back test off the 200, and then we got a nice little push off that. Got my confirmation candle, entered in the middle of this wick or the top of this one. I felt comfortable not waiting for the top of the wick over here. But a great push up, a great sell point, and overall a pretty easy trade. So I'm going to switch now to the 3-minute chart, okay? And I'm going to show you what happened at the beginning of the day. So this was at 8:30 when CPI data came out for farming sectors, non-farm payroll, a bunch of stuff like that. And obviously it was hugely bullish because we went from 4,008 to 4,041. That's a gigantic move in like a minute. 30-point move in a minute. Oh my gosh. I'll take it any day. But you can see the fair value gap that this created. That's ICT trading strategy. Basically says any push in any direction between this green candle, the top of the wick, and this green candle, the top of the wick. Well, actually, I'm sorry, it's this one, the bottom of the wick, and this one, the top of the wick. This gap that's created, the market will have a tendency to fall back into that area and fill it. and at least halfway. Okay, so you can see right off the start, that was the move that I was trying to play, but I got in a touch too early. I got stopped out, and then I didn't get right back in and make the play again. I could have, but I didn't. And that is exactly the play that you saw right off of open, right back, 50% of this gap, this huge green candle, boom, filled instantly. That would have been a great little put play if I executed it properly. So let me erase these guys. This is the rest of today. You know, we're clearly in a range, descending. It's kind of broadening wedge, but kind of not. Let's see what we look at here. Draw some quick trend lines. You know, let's go for the top, the bottom. Whoop. Yeah, it looks more like we're in a channel than a wedge. This wick is a little inconsistent. I mean, you might be able to say, well, that one's an oddball, it doesn't really count. And then we're in more of a broadening wedge instead of a channel. But, you know, take your pick. Everyone analyzes charts differently. Everyone draws them differently. They're just references. But it's uncanny the way, look at this, this, and this, and I just continue this line out, and look, there we are again. I draw this from this, just miss this, right to here, to this again. Traders trade off these charts. You know, it reaches a specific level, and then they're all selling. And this run gets kicked, and now we're in a downturn. And the downturn hits the bottom of the channel, and everyone's like, oh, we're at the buy a channel, time to start buying again. And then we buy, and it rips back up. Like, people want to say, like, you know, charting is for fools and it doesn't matter, but you can clearly see the results of a quick, look, I drew this in 2 seconds and it already lays out a nice little price point. This guy might not make it back all the way, he might bounce off to 200, who knows, but here to here will be a great little put play if you want to do it. Anyway, the only other thing I wanted to touch up on was how I come up with my stop losses. And if you want to calculate them, there's this easy to use Black-Scholes formula, best known options pricing method. That's derived by multiplying the stock price by cumulative standard normal probability distribution functions, blah, 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 blah. So if you want to take the time to use this formula, I mean, just go right ahead and try to do that real time. No, I don't use that. That thing's freaking ridiculous. Almost more ridiculous is this options calculator, which tells you to put the option symbol in, your price, your strike, days to expiration, what the volatility is, and then all of the 5 Greek symbols, and come up with your option price. Like, that's ridiculous. I don't know that I would ever get fast enough at doing that, but what I typically do is the more you trade, the more you learn the price action, right? So this SPX contract that I had right here, it was 2 of them. I think I bought at 240, 240.65 calls, and I put my stop loss at 215. So if I got stopped out, I'd be losing 50 bucks. If not, you can see this stop was never challenged. So you kind of gauge it by the strength of the move you think you get. How is the market structured? Is it a riskier play? Do I want to give it room to move? Do I want to just say, hey, I'm either going to boom or bust. I'm either going to hit it just right, or I'm going to take a small stop. It's all up to your own preference and the style and the risk and how aggressive you want to be as a trader. But I don't use any of those tools to set my stops. You can pretty much just learn from, okay, I'm at right here and I want to set my stop right here. That's 40.20 to 40.24. It's probably, $40. And you just learn over time how much you want to set your stop for. It's all, it's a quick move. I'm buying a contract for $300. How much do I want to lose? Okay, I'm comfortable with $30 a contract. So, okay, my stop is $270. Like, it's not rocket science sometimes. You just assessing what you're comfortable in losing if the move turns against you and kicks you in the nads. So anyway, hope you got something from this, and I'll see you guys next time.